Hi guys! Enjoy John's analysis.
Friday morning, March 27th, 2026. Most people were just waking up. The stock market was about to open. Bonds were trading. Oil was moving. The traditional financial system was doing what it always does on a weekday morning, slowly coming to life, waiting for Wall Street to flip the switch. But Bitcoin had already been awake for hours, and sometime in the early hours of that Friday, while most retail traders were still asleep, still making coffee, still checking their phones for news, something happened in the Bitcoin market that looked completely normal. Bitcoin dropped, not dramatically, not with breaking news, not with a war escalation or a Fed emergency meeting or a company collapse, just a quiet, steady, deliberate move lower. By the time the dust settled, Bitcoin was sitting at $66,453, the lowest price in 2 weeks. In a single day, one single day, $300 million in long positions were liquidated, wiped, closed automatically. Traders who had bet that Bitcoin was going up watched their accounts get margin called with no warning and no mercy. And then, almost immediately, the selling stopped. The price didn't collapse further, it didn't spiral, it just stopped, right there, at $66,000, as if someone had pressed a button. Now, before I show you anything else, I need you to hold one question in your mind. Was this a crash or a harvest? Because those are two very different things. A crash is panic. A crash is unorganized sellers overwhelming buyers because something broke. A company failed, a bank collapsed, a war escalated beyond what anyone expected. A crash is emotional. A crash is messy. A crash does not follow a script. A harvest is different. A harvest is organized. A harvest has a setup, an execution, and a clean conclusion. A harvest leaves the harvester with more than they started with, and leaves everyone else wondering what just happened. $300 million in long positions liquidated in 24 hours. Not $3 billion, not a systemic event. Just enough to collect the fuel that had been sitting there, waiting. The stops, the leveraged longs, the retail traders who bought between $68,000 and $72,000 over the past few weeks, and were now getting washed out at exactly the wrong moment. And while that was happening, while that $300 million in longs was being liquidated, something else was happening at the exact same time. Bitcoin ETFs saw $171 million in outflows, the largest single-day outflow in 3 weeks. Headlines everywhere said the same thing. Investors were scared. Investors were leaving. The institutional money was walking out the door. Except it wasn't. Not all of it. Because while the ETF headlines were screaming fear, whale wallets holding between 10 and 10,000 Bitcoin quietly accumulated more than 61,000 Bitcoin over the past 30 days. And Strategy, the company that has made buying Bitcoin its entire corporate identity, was sitting on 762,099 Bitcoin, bought at an average price well below where we are today. The fear and greed index hit 10. Extreme fear. It had been in fear territory for 46 consecutive days. And the largest options expiry of 2026 and $14.16 billion was sitting on Deribit, expiring that same Friday. Now let me ask you that question again. Was this a crash or a harvest? Here is what I'm going to show you in this video. I'm going to show you exactly what happened on that Friday morning. Not the headline version, not the Twitter version, but the market structure version. The version that shows you precisely how $300 million in retail positions got collected in a single move. Then I'm going to take you back 100 years to a man named Richard Wyckoff, a Wall Street insider who figured out in 1910 exactly how this game is played. His work was buried, dismissed, ignored by mainstream finance for decades. And yet here we are in 2026, watching his blueprint execute in real time on a digital asset that didn't exist until a century after he wrote it down. After that, I'm going to show you how to read the language these operators use, because they do leave fingerprints. They can't help it. The fingerprints are in the volume. And once you know how to read volume the way Richard Wyckoff and Tom Williams taught it, you will never look at a red candle the same way again. And finally, I'm going to show you what history says happens next. Because if what happened on March 27th follows the pattern that Wyckoff documented across decades of market history, then the people who got harvested on Friday may have just given a gift to everyone who stayed calm and paid attention. Let's build this from the ground up. I want to show you something specific. Pull up the Bitcoin 4-hour chart from March 27th, 2026. Find the window between midnight and noon UTC. Look at the 3 red candles sitting there, side by side. Most people looked at those 3 candles and saw the same thing. A sell-off. Bitcoin going down. Bad news. Move on. But those 3 candles tell a completely different story when you know how to read them. And by the end of this video, you will never look at a red candle the same way again. Let me walk you through each one. Candle 1, widespread, large body, The price moved aggressively from top to bottom, covering significant ground in a single 4-hour window. Volume was high. This is what a genuine selling event looks like from the outside. A lot of sellers, a lot of movement, Bitcoin dropping with force and conviction. This is the candle that triggered the headlines. This is the candle that triggered the stop losses. This is the candle that swept through the liquidity sitting below the support levels that had been building for the past several weeks. The stops of every trader who had bought Bitcoin between $68,000 and $72,000 had placed their protection just below the recent lows. In volume spread analysis, which I'll explain in full detail later in this video, this is called a selling climax. A mirror image of a buying climax. A sharp, fast fall on enormous volume with the close coming off the lows. Panic selling from retail participants. And on the other side of every one of those panic sells, a buyer. A patient, organized, well-capitalized buyer who had been waiting for exactly this moment. Candle 1 was the event, the trigger, the engineered drop that collected the fuel. $300 million in long positions liquidated. That fuel didn't disappear, it transferred. From the accounts of traders who got stopped out, directly into the hands of whoever was on the other side of those trades. Candle 2. Now here is where it gets interesting. Candle 2 is approximately 1/3 the size of Candle 1. The spread, the distance between the high and the low, is dramatically smaller. The price barely moved, but the volume? Higher than Candle 1. Let that sit for a moment. More effort, less result. In VSA, this is one of the most important signals you can find on any chart. It has a name. Effort versus result. The law is simple. Volume is the effort and price movement is the result. When you put enormous effort into a move and get almost no result, something is wrong. The market is telling you that someone is absorbing the selling. Every seller that shows up is being met by a buyer with deep enough pockets to stop the price from falling. This is not panic. This is not random. This is organized absorption. Think of it like trying to push a car down a hill while someone on the other side is quietly pushing back. You're exerting maximum effort. The car barely moves. You don't see the person pushing back, but you can feel it in the result. That is exactly what Candle 2 is showing you. The sellers came back with more firepower than Candle 1, and the price went almost nowhere because someone was there, waiting, absorbing every share of selling pressure with calm, systematic buying. Candle 3, a doji, almost no body. The open and close are nearly identical. The price went nowhere in 4 hours. Volume, still elevated. Higher than Candle 1, slightly lower than Candle 2, but still enormous relative to normal market activity. This is the final signal. In VSA, a doji on ultra-high volume after a selling sequence has one primary interpretation. The sellers are exhausted. Think about what this candle is saying. The volume tells you that a massive number of transactions are happening. Money is moving. There is enormous activity in the market. But the price? The result of all that activity is essentially zero, a flat line, a standstill. That only happens one way. For every seller still entering the market, there's a buyer absorbing them immediately. The sellers are running out of ammunition. The buyers have an essentially unlimited supply of it. The battle between supply and demand has reached a stalemate, and in VSA, a stalemate after a sharp decline almost always resolves in one direction. Up. Now let me show you the complete sequence again, this time as a single story. Candle 1, a wide, aggressive down move on high volume. A selling climax. Retail stops get triggered. $300 million in longs get liquidated. Liquidity is collected. Candle 2, the sellers come back harder. More volume than Candle 1. But the price barely moves. Absorption. Smart money is buying every seller that shows up. Candle 3, a doji on still elevated volume. The sellers are losing conviction. The buyers are holding the line. Exhaustion of the downside. Move. 3 candles. 3 phases of a single coordinated operation. And here's the question I want you to hold before we go any further. If this was just a crash, if this was just random panic selling by scared retail investors, why does it follow a pattern? Why does it have 3 distinct sequential phases? Why does the volume behave in exactly the way that Richard Wyckoff described in 1910 when he documented how professional operators accumulate positions at the expense of retail traders? Panic doesn't have phases. Panic is messy. Panic doesn't produce textbook effort versus result signals on a 4-hour chart, but a harvest does. Before we go further, pause. I want to know something first. Where in the world are you watching this right now? Drop it in the comments. Your city, your local time, and what the weather looks like outside your window. I rate every single one. Are you watching from New York? Are you a trader in Seoul on his lunch break? Or a guy in Calgary on a night shift who is questioning his life choices? That is what this channel is built for. While you're down there, if you're not subscribed, now is the time. Not because the algorithm needs feeding, because the next video in this series goes somewhere this one doesn't have time to go. and you're going to want to be there for it. All right, before I take you back 100 years to Richard Wyckoff, I need to show you something that's happening right now, in real time, in the same market where $300 million in longs just got wiped out. Because if this was a harvest, and I believe the evidence strongly suggests it was, then someone did the harvesting. So who are they? Let me show you the structure of the Bitcoin market as it actually exists in 2026. Not the way it's described in news headlines, not the way it's discussed on social media, the way it actually works, layer by layer. Layer 1, retail traders. These are the participants whose stop losses got triggered on March 27th. The traders who bought Bitcoin somewhere between $68,000 and $72,000 over the past several weeks placed their protection just below support and watched their positions get closed automatically when the price swept below $66,000. The $300 million in liquidated longs, that's mostly here. This layer reacts. This layer follows momentum. This layer reads headlines and makes decisions based on fear and greed. And on March 27th, the fear and greed index was sitting at 10. Extreme fear. It had been in fear territory for 46 consecutive days straight. The retail layer was already exhausted, already scared, already looking for any reason to exit. They got one. Layer 2, institutional ETFs. This layer changed the Bitcoin market permanently when the first spot Bitcoin ETFs launched in January 2024. And by March 2026, these products have accumulated an extraordinary concentration of Bitcoin. BlackRock's iShares. Bitcoin Trust, ticker IBIT, holds 785,308 Bitcoin as of March 20th, 2026. 785,000 Bitcoin. In a single fund, managed by a single company, with approximately $55 billion in assets under management. IBIT alone represents 45% of all assets across every US-listed spot Bitcoin ETF product. During a 6-day inflow streak in early March, IBIT captured 78% of total Bitcoin ETF inflows, from every competing product combined. On March 4th, IBIT pulled in $306 million in a single session. Now here is the detail that matters for what happened on March 27th. $171 million left Bitcoin ETFs on that Friday. The largest single-day outflow in 3 weeks. Headlines frame this as institutional money running scared, investors abandoning Bitcoin, smart money leaving the building. But look at the context. The week of March 9th through 13th alone saw $767 million in net inflows into Bitcoin ETFs, the first unbroken 5-day inflow streak of 2026. BlackRock was adding hundreds of millions per day just 3 weeks before the so-called exodus. One day of 171 million in outflows does not erase weeks of accumulation. But it does create a headline, and headlines move retail. Layer 3, the sovereign accumulators. Strategy, the company formerly known as MicroStrategy, led by Michael Saylor, holds 762,099 Bitcoin as of March 24th, 2026. $57.69 billion invested. Average cost of $75,694 per coin. Here's the number I want you to sit with. Strategy's average purchase price is $75,694 per Bitcoin. Bitcoin on March 27th was trading at $66,453. Strategy is underwater on its position by roughly $9,000 per Bitcoin across 762,000 coins. That is approximately $7 billion in unrealized losses on paper. And yet, the week of March 16th through 22nd, with Bitcoin trading between $68,000 and $70,000, Strategy went back into the market and bought 1,031 more Bitcoin for $76.6 million. They did not sell. They did not panic. They bought. Why would a company sitting on $7 billion in paper losses go back into the market and buy more? Either Michael Saylor is making the most reckless financial decision in corporate history, or he knows something that the retail layer does not. Layer 4, the whales. This is the layer that Wyckoff called the composite man. Anonymous, operating through wallets, unconstrained by quarterly earnings calls or SEC filings or public perception. Wallets holding between 10 and 10,000 Bitcoin, the category that blockchain analytics firm Santiment defines as whales and sharks, added 61,568 Bitcoin over the past 30 days. $1.8 billion in purchases, quietly accumulated while geopolitical tensions spiked, while the fear and greed index sat at extreme fear, while retail was selling. The smaller wallet cohort, wallets holding under 0.01 Bitcoin, added 213 Bitcoin in the same period. Let me put that in plain language. The biggest players in the market added 61,568 Bitcoin last month. The smallest players added 213. The ratio of accumulation between large holders and retail is approximately 290 to 1. Dominic John, an analyst at Zeus Research, told Cointelegraph exactly what he believes this means. The whales are positioning ahead of a potential breakout, quietly stacking during consolidation periods. Now I want you to hold all of this in your mind at the same time. The fear and greed index at 10, extreme fear, for 46 consecutive days. Retail exhausted and scared. 300 million in long positions just wiped out. 171 million leaving ETFs on a single Friday. Headlines screaming danger. And simultaneously, BlackRock holding 785,000 Bitcoin. Strategy buying more on the way down. Whales adding 61,000 coins in 30 days at a rate 290 times faster than retail. This is not a picture of a market in panic. This is a picture of a market where one layer is in panic and another layer is systematically absorbing everything that layer is selling. This is the oldest game in financial markets, and I mean that literally, because a man named Richard Wyckoff documented exactly this dynamic in 1910 on Wall Street, before Bitcoin existed, before ETFs existed, before computers existed. And the mechanics he described are playing out on this chart right now with almost eerie precision. How did Wyckoff figure this out? What exactly did he see? And what does his model tell us about what happens next? That's exactly what we're going to build, starting right now. 1888. Richard DeMille Wyckoff was 15 years old. He had no money, no connections, and no formal education in finance. He walked into a New York brokerage firm and took the only job available to someone his age, stock runner. $5 a week, carrying documents between firms, watching the action on the trading floor, listening, learning, reading the tape, the continuous stream of price and volume data that scrolled across the ticker machines in every brokerage office in Lower Manhattan. What Wyckoff discovered in those early years, and spent the next 4 decades refining, was something that Wall Street's most powerful operators did not want the public to understand. The market is not random. It has a logic. And that logic is driven by the deliberate, coordinated actions of a small number of extremely well-capitalized players who accumulate assets quietly, drive prices higher, distribute those assets to the public at the top, and then engineer the decline that lets them do it all over again. Wyckoff watched this cycle happen, not in theory, but in practice. He was personally acquainted with Jesse Livermore, J.P. Morgan, James Keane, and E.H. Harriman, the legendary operators of the early 20th century. Men who moved markets with a precision that looked to the untrained eye like the invisible hand of supply and demand, but was, in fact, a carefully planned campaign. In 1907, Wyckoff founded the Magazine of Wall Street, the first financial magazine in America. By 1910, he had published Studies in Tape Reading, his foundational work on reading price and volume. He was one of the most widely followed market advisors of his era. At his peak, his buy and sell signals commanded a following so large and so responsive that his own recommendations moved the markets he was analyzing. And then, at the height of his career, he did something unusual for a man of his stature. He turned away from making money and toward teaching people how the game was actually played. In 1931, he wrote the comprehensive course that would become known as the Wyckoff Method. He sold it by correspondence. He wanted ordinary investors to understand what he had spent 40 years learning inside the machine. He died in 1934. His blueprint is still running, right now, on a 4-hour Bitcoin chart in 2026. But who exactly is the composite man, the central character in Wyckoff's theory, and who plays that role in the Bitcoin market today? That's where this gets interesting. Richard Wyckoff spent 4 decades watching the same cycle repeat. Not the same stocks, not the same industries, not the same economic conditions, the same cycle, over and over again, in bull markets and bear markets, in crashes and in recoveries, in railroad stocks in 1910 and in tech stocks in 1999. And the reason it repeats is simple. The cycle isn't driven by economics, it's driven by human nature, and human nature doesn't change. Here are the 4 phases. Phase 1, accumulation. The market has been falling. The news is terrible. Everyone who bought at the top has been sitting on losses for months, sometimes years. The retail layer has given up. The headlines are relentlessly negative, and the fear and greed index is at the lowest levels it has registered in a long time. This is exactly the moment Wyckoff's composite man goes to work. He doesn't buy everything at once. He can't. He has too much capital. A single massive buy order would move the price against him, alerting every other market participant that something is happening. Instead, he accumulates gradually, quietly, over weeks and months. He buys on weakness, absorbs selling pressure, keeps the price from falling further, and lets the negative narrative do the work of keeping retail sellers engaged and retail buyers too afraid to participate. The accumulation phase looks, from the outside, like nothing. Sideways price action. Boring, unremarkable. This is by design. In Bitcoin's history, this phase appeared clearly in 2015 to 2016, a 10-month accumulation range after the collapse from the 2013 peak, while most retail participants had completely abandoned the market. It appeared again in 2018 to 2019. A 4-month base between $3,000 and $4,200 after the catastrophic decline from the 2017 all-time high near $20,000. The selling climax in December 2018 was followed by a spring in early 2019, a brief dip below support designed to trigger the final round of stop losses, before Bitcoin reclaimed the range and launched above 4,200 in April 2019, initiating a rally that took the price above $13,000 within months. The pattern was the same both times: long sideways base, negative sentiment, extreme fear, quiet accumulation by large players, and then a spring. Which brings us to the single most important concept in the entire Wyckoff method. But I'll come back to that in a moment. Phase 2, markup. The accumulation is complete. The composite man has built his full position. He no longer needs low prices. Now he needs the price to go up so that the assets he accumulated at the bottom are worth significantly more. And so the price begins to rise, slowly at first, then with increasing momentum. Retail participants who spent months on the sidelines watching nothing happen begin to take notice. They start buying. Their buying adds fuel to the move. The price accelerates. The news turns positive. Social media fills with optimism. The fear and greed index moves from fear to greed to extreme greed. The composite man is selling into this, gradually, to the new buyers who are entering at higher and higher prices, convinced they are early in a new trend. They are not early. They are the exit liquidity. Bitcoin's markup phases are well documented. 2016 to 2017, Bitcoin went from approximately $400 to just under $20,000. 2020 to 2021, from the post-COVID spring low of approximately $3,800 in March 2020, Bitcoin marked up to $69,000 by November 2021. Every rally along the way was purchased by retail participants, increasingly convinced they were participating in a new paradigm. They were participating in the markup phase of a Wyckoff cycle. Phase 3, distribution. The composite man has been selling into the markup. Now he is approaching the end of his distribution. The price action becomes erratic. The market makes new highs, but the rallies are shorter. The pullbacks are deeper. Volume behavior starts to diverge from price. This phase looks, from the outside, like a market that is struggling to decide its direction. In reality, the direction has already been decided. The composite man is almost out of his position. He is distributing the last of his holdings to the final wave of retail buyers, the ones who waited until the asset was on the front page of every newspaper before they bought in. Bitcoin's April and May 2021 top is one of the most clearly documented Wyckoff distribution patterns in crypto history. The market made a buying climax at $64,000 in April, a surge on enormous volume followed by a sharp reversal. An upthrust, a false breakout above resistance, trapped the final wave of retail longs at the top of the range before the markdown began. By July 2021, Bitcoin had fallen to approximately $29,000. By November 2022, after the FTX collapse accelerated the markdown, it reached $15,500. Distribution doesn't announce itself. It looks like strength, right up until it doesn't. Phase 4, markdown. The distribution is complete. The composite man holds no long positions. The price begins to fall, at first gradually, then with increasing speed, as retail participants who bought during the distribution phase begin to panic and sell. The markdown feeds on itself. Stop losses trigger, margin calls execute. Each wave of forced selling pushes the price lower, triggering the next wave. The news turns catastrophic. And somewhere in the depths of the markdown, at the exact moment when the fear and greed index is flashing the most extreme fear, the composite man begins to accumulate again, and the cycle restarts. Now here's the critical question. In March 2026, with Bitcoin oscillating between $66,000 and $72,000, sitting 46 consecutive days inside fear territory on the fear and greed index, which phase are we in? The evidence from the 3 red candles on March 27th, the volume behavior, the absorption signals, the whale accumulation data, points toward one specific phase. Not distribution, not markdown, re-accumulation. A pause within a larger markup. A zone where the composite man rebuilds his position before the next leg higher. A zone that ends, almost always, with a spring. And if that's what happened on Friday morning at $66,453, then the most important question is not what happened yesterday. It's what Wyckoff tells us happens after a spring. But before I answer that, I need to show you the single event inside the accumulation phase that Wyckoff called the most important signal in the entire cycle. The move that was specifically engineered to take your money and give it to the composite man. It has a name, and it happened on March 27th. Now I want to show you the single most important event in the entire Wyckoff method. Not the accumulation phase, not the markup, not the distribution, the spring. Wyckoff's own students called it the most important event that can occur in financial markets. And once you understand what it actually is beneath the surface, you will recognize it every time it happens, and you will never be on the wrong side of it again. Here is the setup. Imagine Bitcoin has been trading sideways for weeks. It has a clear support level, a price floor that has been tested multiple times and held every time. Retail traders can see this support level. They have placed their stop losses just below it. They know that if the price breaks below that level, it signals a breakdown, and they will exit their positions automatically to limit losses. The composite man knows this too. He knows exactly where those stops are. He knows that below that support level sits an enormous pool of liquidity, thousands of sell orders, triggered automatically the moment the price touches that zone. And he needs that liquidity. He needs those sell orders to buy from, to complete his accumulation at the lowest possible price. So he pushes the price below support. Not by much, just enough. Just far enough to trigger every stop loss in that zone, to attract every short seller who sees the breakdown and jumps in, to create a brief, violent flush that generates a tidal wave of selling, all of which he absorbs, and then the price snaps back above support, immediately, sharply, as if the breakdown never happened. That is the spring. It is a price move below the support level of the trading range that quickly reverses and moves back into the range. It is a bear trap, because the drop below support appears to signal resumption of the downtrend. In reality, it marks the beginning of a new uptrend, trapping the late sellers. The spring is the most important event in the Wyckoff methodology. Its main function is to capture liquidity by triggering stop losses of long positions and attracting short sellers, whose orders are absorbed by large operators to complete their accumulation. In one move, the composite man accomplishes three things simultaneously. He collects the stops of everyone who is long, he attracts new short sellers who believe the breakdown is real, and he absorbs all of that selling at the cheapest possible price, completing his accumulation position just before the price moves sharply higher. The people who got stopped out watch in disbelief as Bitcoin rockets back above the level where they just sold. The short sellers who jumped in at the breakdown scramble to cover their positions, adding even more buying pressure to the reversal. The harvest is complete. Now let me show you what this looks like in Bitcoin's actual history, because this is not theoretical. This has happened before, multiple times, with extraordinary precision. Bitcoin, December 2018. Bitcoin had been in a brutal bear market for 12 months. The price had fallen from nearly $20,000 in December 2017 to approximately $6,000 by mid-2018. Then, in November 2018, a vicious final leg down began. The selling climax arrived in mid-December 2018. The price broke below the $6,000 support level that had held for months, plunging to approximately $3,100 to $3,200. It looked like total capitulation. Every headline said the same thing. Bitcoin was finished. The bull market was never coming back. Analysts applying the Wyckoff framework at the time projected the spring would occur around December and that a breakout would follow in April. This is exactly when Bitcoin bottomed in 2018 and when the accumulation phase ended in 2019. By April 2019, Bitcoin had reclaimed $4,200. By June 2019, it was above $13,000. Everyone who sold at the December spring, convinced the breakdown was real, watched the markup unfold without them. Bitcoin, March 2020. The COVID crash produced one of the most dramatic springs in Bitcoin's history. In a single 48-hour window, March 12th and 13th of 2020, Bitcoin collapsed from approximately $7,900 to $3,860, a 50% decline in 2 days. Every indicator pointed to catastrophic breakdown. Traditional markets were in freefall. Global lockdowns were beginning. The macro environment could not have looked more hostile. And yet, by April 2020, Bitcoin was back above $7,000. By December 2020, it was above $20,000 for the first time in 3 years. By November 2021, it reached $69,000. The March 2020 low, but the moment of maximum panic, was a textbook spring. The people who sold at $3,800 handed their Bitcoin to whoever was buying it. And whoever was buying it turned a 2-day catastrophe into the foundation of a 400% markup. Bitcoin, January 2024. When the spot Bitcoin ETFs were approved in January 2024, the market made a counterintuitive move. The price, which had been building in anticipation of the approval, immediately sold off after the announcement. A classic sell the news reaction that swept stops below key support levels before reversing sharply higher. Bitcoin then consolidated, stabilizing around $60,000 before breaking out to new all-time highs above $100,000 by late 2024. The spring, at the ETF approval, was phase C of a reaccumulation structure. the final shakeout before the markup that took Bitcoin from the low 60s to above $100,000. 3 springs, 3 moments of maximum fear, 3 moments that looked from the outside like genuine breakdowns and turned out to be the most important buying opportunities in Bitcoin's history. Now look at what happened on March 27, 2026. Bitcoin breaks below the support range that had been established over the preceding weeks. $300 million in longs get liquidated. The stop losses that were sitting below that support triggered automatically. The volume on the down move is enormous. And then the candle 2 and candle 3 pattern we examined earlier. High volume, minimal price movement, absorption, exhaustion. The spring serves 3 critical functions. Liquidity capture. The triggered stops are absorbed by institutions at bargain prices, completing their accumulation. Strength verification. If price rebounds quickly with low volume after the spring, it confirms absence of sellers. And psychology. The shakeout of weak hands who doubt, leaving only convinced holders. All 3 functions appear to be present in the March 27th event. Does that mean this is confirmed as a spring? Not yet. Wyckoff's method requires confirmation, specifically a secondary test of the spring low on significantly reduced volume, followed by a sign of strength that breaks the upper boundary of the trading range. We have not seen that confirmation yet as of the time of this recording, but the anatomy is there, the structure is there, and the historical precedent is unmistakable. Now, there is one more piece of evidence I need to show you, because everything I've described so far, the phases, the spring, the composite man, it all lives in the price action. But the real fingerprints are in the volume, and that's where Richard Wyckoff's greatest successor comes in. Wyckoff never named the composite man. That was intentional. He described the composite man as a heuristic, a mental model, a way of thinking about the market as if it were controlled by a single, all-knowing, infinitely patient operator who plans every campaign from beginning to end, executes without emotion, and concludes only when the maximum amount of capital has been transferred from the uninformed to the informed. Wyckoff wrote it this way: all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. One man, one plan, one campaign. In 1910, that was a useful fiction. The composite man represented the collective behavior of Jesse Livermore, J.P. Morgan, James Keene, the legendary operators whose individual campaigns were large enough to move entire markets and whose motives were opaque to everyone outside their inner circle. In 2026, the composite man is no longer a fiction. He has a name, he has a ticker symbol, he has a press release and a quarterly earnings call, and he manages more Bitcoin than any entity in the history of financial markets. His name is Larry Fink, and the organization he runs, BlackRock, is the single largest holder of Bitcoin in the traditional financial system. Let me give you the numbers in full. BlackRock's iShares. Bitcoin Trust closed the year 2025 with approximately 771,000 Bitcoin under management. By March 20th of 2026, that figure had grown to 785,308 Bitcoin, held in a single regulated fund, accessible through any standard brokerage account, managing approximately $55 billion in assets. 785,000 Bitcoin in one fund, managed by one company, with $13.5 trillion in total assets under management across all products globally. This is the composite man. But here is what makes this particular composite man so different from the one Wyckoff described a century ago. He tells you exactly what he is doing. In December 2025, Larry Fink appeared at the New York Times Dealbook Summit and described Bitcoin as an asset of fear, a hedge that investors turn to during periods of economic uncertainty. He said Bitcoin could eventually reach $700,000 per coin if sovereign wealth funds allocated just 2 to 5% of their portfolios to the asset. In a December 2025 op-ed co-authored with BlackRock President Rob Goldstein and published in The Economist, Fink argued that Bitcoin and tokenized assets could experience adoption at a pace that rivals or surpasses the early expansion of the internet. In October 2025, in a 60 Minutes interview, he called Bitcoin not a bad asset, a statement that, coming from the CEO of the world's largest asset manager, lands very differently than the same words from a crypto influencer. This is a man who called Bitcoin an index of money laundering in 2017. He spent years publicly dismissing it. And then, methodically, deliberately, and with complete transparency, he built the largest regulated Bitcoin position in the history of traditional finance. Wyckoff would have recognized this campaign immediately. The accumulation phase, conducted in plain sight. Because when you are BlackRock, you do not need to hide. Now add the second layer of the modern composite man. Strategy, the company led by Michael Saylor, holds 762,099 Bitcoin, $57.69 billion invested, average cost of $75,694 per coin. And as we established earlier, they bought 1,031 more Bitcoin the week of March 16th through 22nd, with the price already trading below their average cost. This is not irrational behavior. This is the behavior of a player who has studied the Wyckoff cycle and concluded that the current phase, reaccumulation, potential spring, fear and greed at extreme fear for 46 consecutive days, is not a reason to exit, it is a reason to add. And then the third layer, the anonymous whale wallets. 61,000 Bitcoin accumulated in 30 days. No press release, no earnings call, no ticker symbol. Operating exactly as Wyckoff's original composite man operated, through pure market action, visible only in the volume and the price behavior of the chart. 3 layers, 3 expressions of the same force, all accumulating, all absorbing selling pressure, all waiting. Wyckoff spent 40 years documenting what happens after the composite man finishes accumulating. The price goes up. But to understand exactly when and exactly how, we need to read the one language that the composite man cannot hide. The language that tells you precisely what is happening beneath the surface of every candle on this chart. That language is volume. And the man who decoded it most completely was not Wyckoff. It was his successor, a man named Tom Williams. That's next. So where are we? Let me give you the honest Wyckoff diagnosis of Bitcoin's position as of March 28th, 2026. Not a price prediction, not a target, a structural read based on the framework we've built together over the last 20 minutes. Here are the facts on the ground. Bitcoin is currently trading near $68,000, down roughly 38% from its October 2025 high above $109,000. 5 consecutive months of negative returns have pushed the fear and greed index to extreme fear territory. The 50-day moving average has crossed below the 200-day moving average, a technical configuration associated with sustained downtrends. That is the bear case, and it is a legitimate one. Now here is the Wyckoff read. Bitcoin has been trading within a high-density accumulation band between $60,000 and $72,000. This range reflects structural negotiation rather than directional conviction. A decisive break above resistance or below support will likely determine the next major move. In Wyckoff terms, this is Phase B and Phase C territory, the long sideways range where the composite man is completing his accumulation. The spring on March 27th, the sweep to $66,453, fits the anatomy of Phase C, the shakeout. The final collection of retail stops before the markup begins. But here's what Wyckoff requires before you can call it confirmed. 2 things must happen. First, a secondary test. The price must return to the spring area, not break below it, but approach it, on significantly reduced volume. Lower volume on the retest confirms that sellers have been exhausted. The supply that drove the spring has been absorbed. There's nothing left to push the price back down. Second, a sign of strength. A sign of strength takes place after the spring and indicates the return of bullish sentiment to the market. The price recovers the area of initial support of the entire Wyckoff accumulation, confirming the false breakdown and initiating the markup phase. Glassnode data shows roughly just 1% of Bitcoin's circulating supply, cites between $72,000 and $80,000, creating a low resistance zone often referred to as an air pocket. More than 400,000 Bitcoin were accumulated between $60,000 and $70,000 during the recent pullback, potentially strengthening support below current levels. What that means in plain language, if Bitcoin breaks above $72,000 with conviction and volume, there is very little supply between there and $80,000. The composite man would be pushing price through a zone where almost nobody is sitting on a position waiting to sell. That is what a sign of strength into an air pocket looks like. We are not there yet. The secondary test has not occurred. The sign of strength has not fired. As of this recording, we are watching, not confirming. But to know exactly what to watch for and how to read it when it comes, you need one final tool. The tool that makes volume readable. The tool that turns noise into signal. The language that the composite man cannot hide. That language has a name, and the man who decoded it most completely spent decades refining what Wyckoff started. His name is Tom Williams, and what he built is called volume spread analysis. Richard Wyckoff gave us the map. He showed us the 4 phases of the cycle. He described the composite man. He documented the spring, the upthrust, the accumulation, and the distribution. He gave ordinary investors a framework for understanding what was really happening in markets a full century before most people even believed markets could be understood. But Wyckoff had a limitation. He described the what. He didn't fully decode the how. Because the what, the phases, the structure, the campaigns, is visible in price. But the how, the mechanism, the fingerprints, the real-time evidence of what the composite man is doing at any given moment, that lives in the volume. And reading volume the way Wyckoff intended it to be read required a level of bar-by-bar precision that Wyckoff's era of hand-drawn charts could not fully systematize. That work was completed by a man named Tom Williams. Tom Williams was not an academic. He was not a financial journalist. He was not a theorist writing about markets from the outside. He was a syndicate trader. In the 1960s, Williams was working in Beverly Hills for the boss of an elite group of trading syndicates, the kind of operation that exists to do, professionally and at scale, exactly what Wyckoff described the composite man doing: accumulate, mark up, distribute, collect the stops, repeat. Williams wasn't just adjacent to this operation, he was inside it. He hand drew the charts the syndicate used to plan their speculative attacks, and in doing that, drawing bar after bar after bar, watching volume and price move together, he began to see something: a relationship, a consistent, repeatable, logical relationship between volume, the spread of each bar, and where the price closed within that spread. A relationship that told you, if you knew how to read it, exactly what the smart money was doing at any given moment. The syndicates sent him to the Wyckoff chart reading course to formalize what he was seeing. He completed the course and recognized that Wyckoff had documented the same relationship decades earlier, but had not systematized it into the bar-by-bar reading methodology that Williams was developing. Williams retired from professional trading at 40. He had made enough money that he never needed to trade again, and instead of disappearing quietly into a comfortable retirement, he spent the next several decades doing something unusual for a man with his knowledge. He tried to teach it. He wrote 2 books: The Undeclared Secrets That Drive the Stock Market, published in 1985, and Master the Markets. Between them, these 2 books have been distributed to over 100,000 traders worldwide. He founded Genie Software Ltd., later renamed Trade Guider Systems, to computerize the VSA method and produce automated signals based on the framework. From 2012 to 2015, he ran weekly investment webinars called Closing Bell, teaching his methodology live to anyone who would listen. Tom Williams died in 2018, but his methodology, which traders now call volume spread analysis, or VSA, and which Williams himself sometimes described as Wyckoff on steroids, is alive on every chart in every market in the world right now. Including Bitcoin's 4-hour chart from March 27th, 2026, VSA is built on exactly 3 inputs, nothing more: volume, spread, close. Volume is the effort. It tells you how much activity occurred during a given bar, how many transactions happened, how much capital changed hands. Volume does not lie. It cannot be faked. When volume is high, something real is happening. When volume is low, the market is quiet. Spread is the result. It is the distance between the high and the low of the bar, the range of price movement. Wide spread means the price moved a lot. Narrow spread means it barely moved. Close is the verdict. Where did the price end up within that spread? If the close is near the top of the bar, buyers won the battle of that period. If the close is near the bottom, sellers won. If the close is in the middle, the battle was inconclusive. Combine all 3, volume, spread, close, and you have everything you need to read what the smart money is doing, because the smart money cannot hide. No matter how patiently they accumulate, no matter how carefully they distribute, their activity always shows up in the volume. And the volume always tells a story. Williams described it this way: VSA looks for the reasons for the price movement, and based on these reasons, can predict future price behavior. The reason is always an imbalance between supply and demand, provoked by the actions of professionals. The imbalance always results in a bull or bear market, depending on the prevailing conditions. Now let me show you the 4 core signals, the 4 patterns that Tom Williams spent decades identifying and systematizing, the 4 fingerprints that the smart money leaves behind, whether they want to or not. Signal 1, the selling climax. A selling climax occurs at the bottom of a downtrend. Volume becomes extremely high, often the highest volume of the entire recent move. The spread is wide. The bar travels a significant distance from top to bottom, and the close, critically, is not at the absolute bottom. It comes in mid-bar, or near the upper half of the spread. That closing location is the key. If pure selling pressure had total control of that bar, the close would be at the very bottom. Every seller that entered the market would push the price lower right through to the final second of the period. But the close is not at the bottom. It's mid-range, or higher, which means that before the bar closed, buying entered. Enough buying to pull the price up from its lowest point, even amid all that selling. Wyckoff described it precisely. The selling climax is caused by a panic sell-off of shares from the public and other weak holders, compared with buying from major interests and sponsors who now see a wonderful opportunity to cover shorts and accumulate at low prices. The shares get into strong hands. That is bar 1 on the March 27th chart. Wide spread. High volume. The price swept below the support level that had been building for weeks, triggering every stop loss in the zone. $300 million in long positions liquidated in a matter of hours. The retail layer panicked, sold, got stopped out. And on the other side of every one of those panic sells, the institutional buyers who had been waiting for exactly this price level were there, absorbing everything. It looked like collapse. In VSA, it was collection. Signal 2, stopping volume. The stopping volume signal is what you see when the composite man shifts from event buying to active absorption. The setup: after a selling climax, the market attempts another leg lower. The sellers who weren't stopped out on the first move come back. New short sellers, attracted by the breakdown, add more selling pressure. The bar moves down again, but here is the signal. The spread is narrow, dramatically narrower than the bar that preceded it, and the volume? Higher, substantially higher than the selling climax bar itself. More effort, dramatically less result. This is stopping volume. The name describes exactly what is happening. The selling is being stopped, not by the absence of sellers, there are plenty of sellers, but by the presence of buyers who are so well capitalized, so positioned, so prepared for this moment that they absorb every sell order that hits the market before it can move the price further down. You are watching, in real time, the composite man completing his accumulation. Think about what this requires logistically. For a narrow spread to occur on higher volume than the selling climax, the buyer on the other side must be able to match immediately, continuously at the current price, every seller that enters the market, not slow them down, match them, absorb them. Because if the buyer slowed down for even a moment, the accumulated selling pressure would push the price sharply lower, widening the spread. The narrow spread on high volume tells you someone is there, someone with essentially unlimited capacity to buy at this price level, someone who does not want the price to go lower, because they are building a position and does not want to move the market against themselves. That is bar 2 on the March 27th chart, approximately 1/3 the size of bar 1, volume higher than bar 1. Price barely moving. The selling effort is enormous. The result is almost nothing. The stopping has begun. Signal 3, no supply. The third signal is the subtlest, and in many ways the most powerful. No supply appears when the selling pressure is exhausted, not just absorbed, but genuinely depleted. The sellers who were willing to sell at these prices have sold. The stop losses have been triggered. The short sellers who jumped in at the breakdown are either already stopped out or sitting on losing positions. The remaining sellers are holding, waiting, uncertain, not yet ready to commit. The signature, a doji or near doji, on still elevated volume. The volume tells you that transactions are still happening, capital is still moving, positions are still changing hands, but the spread is almost zero. The open and close are nearly identical. The price went nowhere in the entire 4-hour period. In VSA, this is called no supply, or exhaustion of selling. For the spread to be essentially zero while volume is still high, there can only be one explanation. For every seller entering the market, there's an immediate buyer absorbing them at the same price. The sellers are running out of sellers. There is no new supply coming in to push the price lower. The selling campaign is over. A doji with ultra-high volume after a selling sequence signals intense battle between buyers and sellers, often before a major market phase change. The high volume confirms the battle is real. The zero spread confirms the sellers are losing. That is bar 3 on the March 27th chart. Doji. Volume still elevated above bar 1, slightly below bar 2. Open and closed nearly identical. Price goes nowhere for 4 hours, despite massive activity. The sellers are exhausted. The buyers are holding the line. The harvest is complete. The law that connects all three. Tom Williams organized all of these signals under a single unifying principle. He called it the law of effort versus result. The law is simple. Volume is the effort, and price movement is the result. When effort and result are in proportion, high volume producing wide spread, low volume producing narrow spread, the market is behaving normally. When effort and result are disproportionate, high volume producing narrow spread, something hidden is happening. And that hidden thing is always the same. The smart money is on the other side of the visible move, high effort. Poor result on a downward move means smart money is buying. They are absorbing the effort of the sellers and producing a result that is close to zero, because their buying exactly neutralizes the selling, keeping the price in place while they accumulate. Low effort, strong result on an upward move means smart money is pushing, with very little resistance because the selling supply that was present during the accumulation phase has now been fully absorbed. The market has no sellers left. Even a small amount of buying pushes it significantly higher. This is why bar 2, the stopping volume, and bar 3, the no supply doji, are so significant on the March 27th chart. Not individually, but in sequence. Bar 1, high effort, wide spread, strong result downward, normal. This is genuine selling, the selling climax. Bar 2, higher effort, narrow spread, almost no result downward, abnormal. Effort is increasing, result is collapsing. The absorption is happening. The stopping volume. Bar 3, still elevated effort, essentially zero spread, zero result, maximally abnormal. Effort remains high, but produces nothing whatsoever in terms of price movement. The no supply, the exhaustion, Each bar is a data point. The sequence is the story. And the story these three bars tell together, in the precise VSA language that Tom Williams spent decades teaching, is unmistakably classically bullish, not a prediction. A reading. The evidence says someone with enormous capital absorbed $300 million in liquidations, took the other side of every short seller that appeared on bar 2, and held the price flat through the entire activity of bar 3 while the remaining sellers exhausted themselves. That entity, whoever it is now sitting on a position built at $66,453. And if Wyckoff's framework is correct about what happens after spring, and VSA's framework is correct about what's stopping volume and no supply signal after a selling climax, then the next question is not whether that entity made a good trade. The next question is, what does history tell us happens next? That is exactly what we're going to build in the next section. Because now, for the first time in this video, we have all the pieces on the table. Wyckoff's phases, the spring, the composite man, Tom Williams' VSA, the three bars, the data from March 27th. Now it is time to close the case. Now I want to put everything on the table at once. We have the framework, we have the method, we have the history, we have the VSA fingerprints. Now let's reconstruct exactly what happened on March 27th, 2026, event by event, layer by layer, and see whether what the data shows matches the pattern that Richard Wyckoff documented over a century ago. This is closing the case. March 27th did not happen in isolation. It was the culmination of a setup that had been building for weeks. Bitcoin entered March after a brutal January and February, 2 consecutive months of negative returns, a 47% decline from the all-time high of $126,080 reached in October 2025. The price had tested the $60,000 level in February, held it, briefly recovered, and then spent the first 3 weeks of March oscillating between $68,000 and $73,000 in a tight, unconvincing range. The technical picture was not pretty. The 50-day moving average had crossed below the 200-day, a configuration that technical analysts call a death cross. The fear and greed index had been sitting in fear territory for 46 consecutive days. The media narrative was uniformly negative: correction, crash risk, institutional exit, crypto winter. But beneath the surface, the accumulation data we examined earlier was building quietly. 61,000 Bitcoin added by whale wallets. BlackRock holding steady at 785,000 coins. Strategy buying more at $74,000 per coin, above the market, in the week before the event. And then, on March 26th, the day before the drop, something quietly significant happened that most retail traders completely missed. For the first time in 2026, Bitcoin, Ethereum, and Solana spot ETFs all posted net outflows on the same day simultaneously. All three. On the same session, one day before the largest crypto options expiry of the year. What are the possible explanations for that? Option 1, pure coincidence. 3 separate ETF products, managed by different institutions, representing different investor bases, all happened to experience net selling on the same day. One session before the largest options expiry of 2026. Option 2, positioning. Institutions with exposure across multiple ETF products, reducing net long delta ahead of the expiry settlement, creating the conditions for the price to print below the max pain level at settlement, and ensuring the maximum number of options contracts expire worthless. You can decide which explanation you find more persuasive. The Deribit quarterly expiry settled on March 27th, $14.16 billion. The largest of 2026, the max pain level, the price at which the maximum number of options contracts expire worthless, was $75,000. Bitcoin was trading at $66,000, $9,000 below max pain. That means that on settlement, almost every bullish options position in the market expired worthless. Every trader who had paid a premium for calls above $75,000, gone. Every structure built on the assumption that Bitcoin would be trading near current levels or higher at the end of the quarter, unwound. And the liquidations that accompanied this settlement were not limited to options. Bitcoin dropped 5% in 24 hours to an intraday low of $65,720. Over $300 million in long futures positions were liquidated. More than 122,000 traders were closed out. Across the entire crypto market, total liquidations exceeded $450 million in a single session. The macro context provided the perfect cover. Iran had threatened to block a second global oil choke point. Oil was trading above $100 per barrel. The 10-year Treasury yield was near 4.5%. The dollar index had strengthened. The Nasdaq and Dow Jones had entered correction territory earlier in the week. Every risk asset was under pressure simultaneously, giving the move the appearance of a macro-driven sell-off rather than a market structure event. But here is what the macro context does not explain. It does not explain why the volume on bar 2, the bar that followed the selling climax, was higher than bar 1. If the selling was purely macro-driven, you would expect each successive bar to show declining volume as the panic exhausted itself. Instead, the volume increased while the spread collapsed. That is not macro fear. That is absorption. It does not explain why the doji on bar 3 had volume still elevated above the selling climax. Macro fear does not produce doji candles on ultra-high volume. Macro fear produces large red candles with closes at the lows. What happened on bar 3 is the opposite of macro panic. It is VSA no supply, the textbook fingerprint of sellers who have been completely absorbed. And it does not explain why exchange reserves hit a 6-year low of 2.31 million Bitcoin on this same week. If institutional money was genuinely exiting, if the ETF outflows represented real selling, you would expect Bitcoin to be moving from cold storage onto exchanges in preparation for liquidation. Instead, the exact opposite is happening. Bitcoin is moving off exchanges at a pace not seen since 2020. That is the behavior of long-term accumulators taking supply off the market permanently, not sellers preparing to dump. The macro was real. The fear was real. The liquidations were real. But the entity absorbing every bit of that selling was also real. And the fingerprints they left in the volume, the stopping volume on bar 2, the no-supply doji on bar 3, tell you exactly what they were doing. If March 27th was phase C, the spring of a reaccumulation structure within Bitcoin's larger cycle, then what comes next, according to Wyckoff, is a sequence of 3 events. First, the automatic rally. The initial recovery from the spring low. Fast, sharp, but not necessarily sustainable, because the market needs to confirm that the supply that drove the spring has actually been absorbed. The automatic rally establishes the upper boundary of what Wyckoff calls the backup zone. Second, the secondary test. This is the critical confirmation event. The price retraces back toward the spring low, not necessarily reaching it, but approaching it, on dramatically reduced volume. Lower volume on the secondary test compared to the spring is the signal that the selling supply has been exhausted. There are no more sellers at this level with meaningful capital behind them. The test holds. The spring is confirmed as genuine. A successful secondary test in the area of the selling climax shows less selling than previously, with narrowing spread and decreased volume generally stopping at or above the same price level as the original spring low. As of this recording on March 28th, Bitcoin is trading at approximately $66,000, within cents of where it was when the spring low was printed yesterday. The automatic rally has not yet materialized with conviction. The secondary test has not yet occurred. We are in the hours immediately following a potential spring event, watching in real time. Third, the sign of strength. After the secondary test holds, Wyckoff describes a sign of strength as a price advance on increasing spread and relatively higher volume. It is the market telling you that demand has fully absorbed the remaining supply. On the Bitcoin chart, the sign of strength would be a sustained move above $72,000, the resistance ceiling of the reaccumulation range, on meaningfully higher volume than any recent up bar. Why 72,000? Because Glassnode data shows that approximately 1% of Bitcoin's entire circulating supply sits between $72,000 and $80,000. If Bitcoin breaks above $72,000 with a genuine sign of strength into that air pocket where almost no one is sitting on a position to sell, the price faces almost no supply resistance until the $80,000 zone. That is what a sign of strength into an air pocket looks like, and that is what the Wyckoff framework predicts follows a confirmed spring. I will not give you only the bull case. That would be incomplete and dishonest. Wyckoff himself was explicit. Springs and terminal shakeouts are not required elements. Not every sweep of a support level is a spring. Some are simply breakdowns, the beginning of a markdown phase, not the conclusion of an accumulation. The bear scenario here is specific. If Bitcoin fails to hold the $66,000 support level on a daily close, if the price closes below $66,000 on high volume with a wide red body and a close near the lows, then the structure changes. The $66,000 support that buyers stepped in to defend on March 27th would be broken. The next major support level sits near $60,000, the level Bitcoin tested in February 2026. Below that, the open air pocket extends toward $50,000. A daily close below $66,000 would be the first time Bitcoin has lost that support since the February crash. A break of that level could trigger a move toward $50,000. That is the Wyckoff bear case. What appeared to be a spring turns out to be an upthrust in distribution, a false recovery within a larger distribution structure, followed by a renewed markdown phase. How do you distinguish between the two in real time? Volume on the recovery. If the price rallies from here on increasing volume with each pullback on lower volume, the spring is likely genuine. If the price rallies weekly with declining volume on each push upward and increasing volume on each pullback, The spring has failed, and the structure is more consistent with distribution than accumulation. Watch the volume. It does not lie. Before I close this out, I want to leave you with two numbers that belong in this analysis, because they are structural, not speculative. Number one, stablecoin supply is sitting near a record $316 billion. That is capital that has exited risk assets and is sitting in stablecoins, parked, liquid, available to re-enter the market the moment conditions shift. $316 billion in purchasing power, on the sidelines, waiting. That is not a bearish number. That is potential demand waiting for a catalyst. Number two, Bitcoin's circulating supply reached 20 million coins in March 2026, a historic milestone. Of the 21 million Bitcoin that will ever exist, 20 million are already mined. Roughly 1 million remain, spread across the next 114 years of mining. The supply of Bitcoin is, for all practical purposes, fixed. Every buyer who enters the market at any price is competing for an asset that becomes structurally scarcer with every passing year. The composite man knows this. The whales adding 61,000 coins last month know this. BlackRock knows this. Strategy knows this. The question the Wyckoff framework leaves you with is not whether Bitcoin goes up or down in the next week. The question is whether the entity that absorbed $300 million in liquidations on March 27th at $65,720 to $66,453 made a good trade. History has an answer to that question. It has answered it in December 2018, in March 2020, in the spring of 2025. Whether it answers it the same way in 2026, that is what the secondary test and the sign of strength will tell us. And now you know exactly what to watch for. I want to end this video with something that has nothing to do with price targets. Because if you have made it this far, through the 3 red candles, through the layers of the market, through Wyckoff's 130 years of evidence, and Tom Williams' VSA fingerprints, then you have earned the right to hear the real lesson, the one beneath the charts, the one that Wyckoff was actually trying to teach. And it starts with a question he asked over a century ago. Richard Wyckoff watched retail investors get fleeced repeatedly, not once, not twice, systematically. Cycle after cycle after cycle. He had a front row seat to every major market event of his era. The panics of 1893, 1900, 1907, the crash of 1929. He watched J.P. Morgan move markets. He watched Jesse Livermore build fortunes and lose them. He watched ordinary people, people with savings, with families, with legitimate hopes for financial security, walk into the same trap over and over again. And the trap was always identical. They made decisions based on how they felt, not based on what the market was actually telling them. The headlines made them scared, so they sold. The price going up made them excited, so they bought. The fear and greed index hit extreme fear, so they got out. And the entity on the other side of every one of those emotional decisions, the composite man, in whatever form he took in whatever era, was there, waiting, patient, completely unmoved by the narrative. Wyckoff dedicated the second half of his career to one mission, not to making more money, he had made enough, to teaching people the real rules of the game. He dedicated himself to instructing the public about the real rules of the game as played by the large interests, not the rules printed in the newspaper, not the rules taught in schools, the real rules, the ones operating behind every price, move on every chart, in every market in the world. He believed, passionately, genuinely believed, that an educated investor could not be systematically harvested, not because they would always win, but because they would know what they were looking at when the harvest was happening. And knowing what you're looking at changes everything. Here's something I want you to understand about the market you're operating in right now. In 2026, the Bitcoin market has fundamentally changed, and most retail participants have not adjusted. In every previous Bitcoin cycle, retail traders were the primary engine of price movement, the ICO era, the 2017 mania, the 2021 meme-driven surge. These were retail-led events. Emotion drove price. Narrative drove price. Social media drove price. A tweet from a celebrity could move the market by 10%. That market is over. What began as a speculative playground for retail traders has evolved into a sophisticated asset class, increasingly dominated by institutional capital and underpinned by regulatory clarity and infrastructure innovation. The numbers make this concrete. Public companies like MicroStrategy, Tesla, and others have increased their Bitcoin holdings, collectively owning more than 1.7 million Bitcoin, a substantial portion of the total supply. Institutions absorbed far more daily supply than miners could produce, often by multiples, turning Bitcoin into a macro-sensitive reserve asset rather than a purely speculative one. And the retail layer? Retail investors now represent 5 to 6% of market flows. That means even if millions of people are posting to the moon, they're not buying enough to move prices. The big players, hedge funds, asset managers, corporations, are the ones with the capital to shift markets. 5%. The retail layer that used to drive price discovery in Bitcoin now represents 5% of flows. The other 95% is institutional, corporate, whale, composite man. Institutional Bitcoin holdings continued to expand throughout 2025, while retail investors moved in the opposite direction. What does this mean for you? It means the game has changed, not the rules. The rules are the same ones Wyckoff documented in 1910. Supply and demand, effort and result, accumulation and distribution, springs and upthrusts. The rules have not changed because human nature has not changed. Wyckoff captured human behavior in the form of market action, as reflected in the charts. Human behavior is evolutionary. It has not changed since Wyckoff's time and will not change into the future. But the players have changed. The scale has changed. And the speed at which operations execute has changed. In Wyckoff's era, accumulation took months. Campaigns were slow, deliberate, conducted over years. Today, with algorithmic execution, with derivatives markets that allow positions to be established and liquidated in microseconds, with $14 billion in options expiring on a single Friday, the same operations that Wyckoff documented can execute in hours. $300 million in longs liquidated. 1 day, 3 candles, 24 hours. That is the modern composite man. Let me tell you what you're walking away from this video with. Not a trade idea, not a price target, not a prediction, a framework. A 113-year-old framework that has survived the crash of 1929, the dot-com collapse, the financial crisis of 2008, the Bitcoin bear markets of 2018 and 2022, and the spring events of 2020 and 2025. A framework built by a man who watched the original operators work at close range, who documented their methods with extraordinary precision, and who spent the last years of his life trying to give that knowledge to ordinary investors. You now know the 4 phases. You can look at any chart and ask, is this accumulation? Is this markup? Is this distribution? Is this markdown? And you have the tools to attempt an answer. Not perfectly, not with certainty, but with a framework that gives you a massive informational advantage over the retail participant who is making decisions based solely on price and headlines. You now know the spring. When you see a price sweep below a well-established support level, and followed by a snapback, followed by stopping volume and no supply signals, you will not panic out of your position. You will ask, is this a harvest? Is the composite man collecting stops? And you will watch the secondary test in the sign of strength with informed eyes rather than frightened ones. You now know the VSA signals, selling climax, stopping volume, no supply, effort versus result. You can look at a sequence of 3 candles, widespread, narrow spread, doji, and read the story they are telling. Not perfectly, not as prophecy, but with the same analytical tools that Tom Williams spent decades systematizing from his years inside the professional trading world. And you now know who the modern composite man is. Not a shadowy conspiracy, not an invisible hand, a publicly identified, quarterly reporting, press release issuing entity that holds 785,000 Bitcoin in a single regulated fund, and whose CEO has stated on camera that Bitcoin could reach $700,000 per coin. This is not hidden information. It is public. It is documented. It is verifiable. The only difference between the retail investor who got stopped out on March 27th and the one who watched March 27th with calm understanding is not capital. It is not intelligence. It is not access. Wyckoff said it himself more than 90 years ago. The trained man has all the advantages on his side. The untrained man invites all the tragic possibilities of failure. The trained man, the man who understands the structure, the man who can look at 3 red candles on a 4-hour chart and see not collapse, but collection, not panic, but pattern, not random, but designed. Here is what to watch for from here. 1. The secondary test must hold on reduced volume. Bitcoin must approach the 66,000 area. It may not reach it exactly, but it must test the spring zone and do so on meaningfully lower volume than the selling climax of March 27th. Lower volume on the retest means the sellers who drove the spring have been exhausted. There is no fresh supply entering the market at this level. 2. The sign of strength must break resistance on expanding volume. A sustained move above $72,000, the ceiling of the reaccumulation range, on volume that is noticeably higher than any recent up bar. Not a brief spike, a sustained advance with commitment behind it. That is the composite man, signaling that accumulation is complete and the markup is beginning. 3. Watch exchange reserves. If Bitcoin continues to leave exchanges at the current rate, 6-year lows in reserves, coins moving to cold storage, that is a structural bullish signal that goes beyond any single candle pattern. Bitcoin leaving exchanges is Bitcoin being held by people who intend to hold it for a long time. Supply coming off the market permanently. 4. Watch ETF flows in the week following March 27th. A return to sustained net inflows, particularly from BlackRock's IBIT, after the $171 million outflow day would be a meaningful signal that the institutional layer is back in accumulation mode. None of these are predictions. All of them are structural signals, and now you know how to read them. This channel is called Engineered Markets, and the title of this video says it's rigged. I want to be precise about what I mean by that, because there is a version of rigged that is a conspiracy theory, and there's a version that is simply a structural description of how markets work. I'm not telling you that a shadowy group of people in a room decided on March 27th to crash Bitcoin to $66,000. I have no evidence of that. No one does. What I'm telling you is something that Richard Wyckoff told you in 1910, and what the data from March 27th confirms. The market has structure. The structure favors players with more capital, more patience, more information, and more sophistication than the average retail participant. Those players use that structure, legally, systematically, and repeatedly, to position themselves on the right side of large price moves, often at the direct expense of retail participants who are making emotional decisions based on fear, greed, and headlines. That is not a conspiracy. That is the architecture of financial markets, as they have existed for as long as financial markets have existed. The difference, the only difference, is whether you understand the architecture or you don't. Wyckoff understood it. Tom Williams understood it. The analysts at BlackRock understand it. The whale wallets that added 61,000 Bitcoin last month while the fear and greed index was at 10 understand it. And now, if you made it to this point in this video, you understand it too. The market is never obvious. It is designed to fool most of the people most of the time. That is not a quote from a conspiracy theorist. That is a quote from Richard Wyckoff, a man who spent 4 decades inside the machine watching it operate and then dedicated the rest of his life to explaining it. Panic is a design feature. Extreme fear is a design feature. A sudden drop to $66,000 that liquidates $300 million in retail longs on a Friday morning in front of the largest options expiry of 2026, while exchange reserves sit at 6-year lows and whale wallets are accumulating at 290 times the rate of retail. That is a design feature. You're not helpless against it. You're not powerless. You're not forever destined to be on the wrong side. But you do need the map, and Wyckoff drew it over 100 years ago. If you watched this entire video, thank you. This was not a quick take. This was not a tweet. This was a serious, detailed walk through a framework that took Richard Wyckoff 40 years to build, Tom Williams 30 years to systematize, and that I spent hours making sure was grounded in verified, factual data from March 27th, 2026. If something in this video landed for you, if the 3 candles made sense, if the Wyckoff phases clicked, if the VSA signals gave you a new way to look at a chart, I have one request. Leave a comment below. Tell me where you're watching from. Tell me what time it is where you are. Tell me what the weather is like outside your window right now. I read every comment, every single one. And when I see that someone in Tokyo or Toronto or Sao Paulo or Lagos watched something this long and found value in it, that tells me more than any algorithm ever could. And if you made it all the way to the very end of this video, I want to know. Leave the words, "I see the volume" in the comments. That is the signal. That is how I know you are here, you did the work, and you are ready to see the market the way it actually operates, not the way it wants you to see it. Subscribe if you are not already subscribed. The next video in this series goes deeper into the distribution phase, because understanding where the composite man exits is just as important as understanding where he enters. And the patterns from late 2024 and early 2025 have something important to tell us about what a completed distribution looks like in a market this institutionally dominated. I will see you there. Stay educated, stay patient, watch the volume.